Thank you, Denny, and welcome back to the Retire Young radio show. I am your host, Joshua David, having a good time with my good friend and my good pal, Mr. Al Connickson. Now, Al, as we get into this third segment, there's this retirement topic that we talk about, and everybody has that goal of retiring at one point in their life. And what we're finding, or what I'm seeing out there, is a lot of people can't, but if they do, they're not living their same lifestyle because it's all about having more fun in retirement. Now, the institutions of the smart money, they're always creating returns in the financial markets. We talked about that in the first couple segments. Well, there's retirement accounts that they're managing that the public is giving their money to, right? And they are getting different type of returns. The returns of the average investor is usually much smaller than those returns of the institutions. Why is that? But how can we take more control with more confidence and comfort?
Yeah, not only are the returns of the average investor lower than the institutions, they're actually lower than the indexes themselves. Because there's a number of reasons for that. If you're especially in an employer-sponsored retirement plan, there's a couple things that have a negative impact on your returns. One are the high fees that people pay. And unfortunately, most people just accept the fact that, well, I've got to pay something for this management that I'm getting. Well, think about what kind of management that actually is. When you are presented with your 401k or 403b, you were presented with a group of mutual funds or maybe some ETFs that you could invest in. And then who made the decision? Who really is managing it? It's you. You really are your own pension fund manager, so to speak.
They probably got advice from their direct manager as well. But what does their direct manager even know?
Yeah, even companies don't really want to get involved in making recommendations either because of there's a legal aspect that they're concerned about there. So really, the individual is pretty much on their own, and then you're paying fees for you to actually manage your own money. People accept the fact that maybe, what's 2%? What's that going to hurt, my total return?
That's a lot over time.
Well, it is, because every dollar that's taken out, first of all, is no longer in your account, but it's no longer they're growing. It's no longer compounding for you.
That's that eighth wonder of the world.
The eighth wonder of the world, the power of compounding. So the fees can take a huge amount. Let me just give you an example here. If you think that 2% is high, well, guess again, because most people are paying much more than that. When you look at the all-in cost of a mutual fund plus the fee just that the plan sponsor charges, it could be closer to 4%. And here's an example. If you had $100,000 that you invested for 30 years at 7% a year, the return should be about $761,000. With a 4% fee, the cost to you, the cost, what's taken away from you is $518,000. You keep $242,000, and the loss to you is $500. And so it's twice as much as you get in your pocket, so to speak. So by self-directing, you eliminate those fees, and also you have better choices. The choices within these employer-sponsored retirement plans are actually pretty mediocre when you look at their returns. You can use futures, forex, options. You can use stock. You can, if you want to use mutual funds, you can in a self-directed IRA. But number one, you eliminate the fees. And number two, you have many more choices, and you have choices that will allow you to participate if the market's going down, market's going up, or sideways. And you mentioned one of the C words earlier, which was confidence.
Yeah.
One of the reasons or the ways that you develop confidence is to know that you have the opportunity to participate in all three directions. That takes the fear of a bear market or the fear of a correction out of the equation.
Let's talk about these different directions, and time, right? Because everybody is just purchasing or buying mutual funds every other Friday with no plan of gain or loss and no plan of a time horizon, right?
Right.
Now, what is that one thing we cannot get back? It's that time. So let's talk about the downfall of why time and buying at high prices, which is technically right now, why is that hurting the return of people?
Well, you talked earlier about buying at wholesale and selling at retail, sort of like Costco. Do the financial equivalent of what Costco does. Costco could not buy prices very high and then jack them up and do as well as they do. And the same thing is true in investing. You want to try to buy at the lowest point you can at wholesale prices in an area that gives you maybe the lowest risk entry point with the highest potential of achieving the highest profit. That should be the goal. Unfortunately, when you have money taken out every 2 weeks or every month, and goes into the market. It goes in at whatever the market is at that point. Right now, we've got a highly valued market. In your self-directed retirement account, you can choose when you put that money to use. Maybe it's better off sitting in cash for a while. But if you have a retirement plan, you don't have control over that, employer-sponsored retirement plan. And for most of you that have an investment portfolio, think about it for a minute. If you go to a financial advisor, and if you have done this with whatever amount of money you have, what they're going to tell you is that we need to get that in the market right now. It's time in the market, not timing the market. We think it's just the opposite. It's timing the market, not time in the market. And if you can do that, if you can identify with a high degree of accuracy those ideal buying points and selling points, you do that with the highest profit potential and the highest probability of succeeding. And over time, that can have a huge impact on the returns you get. That time that you mentioned, if you think about this, if the market goes down, your portfolio goes down 50%, you have to have a 100% return just to get back to where you were before. It may take 5 or 10 years to get there. That's that lost time.
And well, Al, a lot of people are probably thinking, well, I don't know how to do that. I don't know how to time the market. I don't have the confidence to do that. Well, it's because you've been conditioned to think you shouldn't be doing it or you can't. Now, there's the wholesale and the retail, but there's also a smart money concept and the novice concept. And you kind of have to get that mindset to say, okay, hey, I want to try to learn this. I want to try to do something a little bit different. And it's not new. It's just a little different. And you have these investing classes that you teach right here at the Academy to help people with that confidence of taking that first step and getting into the market, but also doing it properly so you have more comfort, really so you can make better choices. Al, we know, and you mentioned earlier about these fees, how high they are. It's unbelievable how high fees are when people have their money with a broker or an advisor or a financial planner, whatever that may be. Now, they're technically just a storage facility for their money because you already said you are already making those decisions, but you're doing that without the education, without the knowledge, and without the skill. Now, you mentioned there's ways to remove those fees by self-directing.
Correct.
How does that happen? Because there's another thing here. People don't have that confidence. Let's help people gain the confidence to take more control of their life.
You're right. Pretty much every broker out there will allow a person to set up a self-directed IRA. You don't need in other words, you're not getting the advice of a financial advisor. You are making the decisions on your own. The same thing that you're doing in an employer-sponsored retirement plan, and you can do this on an ongoing basis. If you think about it, a financial advisor that might have 200, 300, 400 clients is not waking up every morning with you on their mind.
I doubt it.
and maybe they'll meet with you once a year, maybe twice a year. But things change with these I'm going to call them volatile markets, these crazy high moving markets. Well, maybe you need to make changes more often than that, and especially if you're looking for that short term cash. If that's your goal is to have something short term, then you maybe have to be a little bit more active. But you mentioned again the word confidence. That one of the things that you need, in addition to knowing how to participate in all three different directions, is a plan.
Yeah.
And that plan includes that core strategy. It includes the type of asset that you are going to be trading or investing. That's why the education you get should give you access to all of the different asset categories that are out there.
Yeah, you just have to be properly allocated. And a lot of people aren't because they think, okay, I'm going to be in all these different stocks. I'm going to be diversified, right? They're in tech stocks. They're in oil stocks. There's thousands and thousands of stocks out there. What happens, and we've seen it, when the stock market goes down? They all go down, so you're not truly diversified. So you need to be properly allocated in those multiple asset classes.
Exactly. Yeah, it's like a bathtub. If you pull a plug on a bathtub, you can't point to a section of water and say, "Hey, don't go down." It all gets sucked down. The same thing happens in the stock market. But so there's some great companies that get hurt during these big corrections and bear markets, which is another great thing because, as Warren Buffett says, I like to buy good companies when they're in the bargain aisle, and that's what happens during these drawdowns. But in order to be able to take advantage of it, you have to have the cash there to do that. So you want to eliminate as much as possible a drawdown in the value of what you have. That's risk management, and that's a critical component of any plan, is to control that. It's controlling your profit, it's controlling your investment, it's controlling your profit, and controlling your risk. And I think even when you're wrong, you're right if you do this properly. And what I mean is that's what the institutions do. They understand that they're not going to be 100%, and nobody will be 100%. So if you're not, then make sure that any loss that is there is a small loss. You can eliminate a big loss by taking a small one, and it's just part of the management of your portfolio.
Yeah, and if you want to gain more confidence in your investments and just have the confidence to make those decisions, because it's all about making better financial decisions, and that's for you and for your family. Al, I believe you're teaching, a couple next week, aren't you?
Correct.
Nice. So in these classes, we get into more of these step-by-step rules-based strategy, which I want you to talk more about in this next segment, because you mentioned having a plan. There's a step-by-step rules-based strategy that proper investing or investors would have in a plan. So let's talk about that. Let's talk about that plan, but most importantly, how to gain the confidence to start. This is Josh and Al with the Retire Young radio show. We will be right back.